Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer and Portfolio Manager. Also have Andrew Thrasher, Chartered Market Technician and also Portfolio Manager. As always, so thankful that you joined us. Well, we're going to go over a few of the topics, and our meeting this week and our allocation meeting was a long one, just that we have so much to unpack this week. And so we're always trying to share with the things that we think you'll find the most impactful, the most important. Hopefully we'll try to keep from going as long as we did yesterday. But nevertheless, fill you in on what we find important, starting with the strength in the dollar. That has been a topic here. And I just want to preface it by saying it wasn't too long ago, especially as we had a lot of international currency things going on with the Russian invasion and the actions that we've taken. A lot of people began to get naturally concerned at what point in time would we see some sort of collapse in the dollar. We had the Saudi Arabians agreeing to purchase oil outside of the dollar. And we shared our thoughts on that in one Market Carver. But in any event, all of that to say that really what we have seen in terms of impact to the global economy has been an incredibly strong dollar. So we've really had the opposite problem with that on the near term. Now, all these currencies are positioned here. We've got 6 major ones from around the globe, from the yen in Japan, to the Chinese yuan and the euro, of course. All of these to say that the dollar has been strong, and broadly we see currencies falling against the United States dollar. So that's having a lot of different impacts. One tangible thing we've seen is the GDP that actually printed a negative quarter. The first quarter GDP here in the United States is down. One of the reasons is because of this dollar strength and the hit it had on exports. So that is one of the things. And then most specifically, I want to focus in on the yen. The Japanese yen is one of the most important of these currencies that has been very weak against the dollar. The Japanese yen has been in what we would call kind of a tight range for a number of years. And the reason for that, why the yen is so important, the Japanese have been trying to create inflation for a number of decades. So it's kind of crazy to think about with all the problems we have here with inflation in the United States. They've been trying to make it happen. And so they've really found themselves at a critical juncture where they have been having a long history of printing yuan, just like we've had to print dollars to buy assets. They have been printing yen in quantities here that make our numbers look small. They have been doing that to keep their yields very low on bonds, and in turn, hopefully create inflation. Well, now they have a problem because all of a sudden they've had a spurt of inflation, just like the rest of the world has. And the consequence of trying to continue to print that yen and keep their interest rates low, the consequence is that their currency has been breaking down. And so we see this on this chart here. It is inverted. The fact that the yen is going up here just simply means that our dollar is now buying 130 yen, whereas not too long, 115 has been the cap for a very long time. So this has many implications. One thing that we just have to keep our eye on, that Andrew and I watch on a daily basis, we're going to see currency movement day in and day out. What we don't want to see is it move so quickly and so extreme that it takes out a leveraged player in the markets. And so far we haven't seen that, but you can see this take out large investment players. We've seen that through time, like in 1998 with long-term capital management, all different factors. But when these move quickly, they can take out leverage players. So I've kind of been rambling on here, Andrew. Wonder if you had to say words, what this means to ETF investors or to portfolios.
Yeah, I think to Adam's point, when we start seeing a lot of moves in currencies, while it may not be something that we're always directly investing in, specific currencies or cross currencies, they do have impacts to foreign markets. The volatility that can stem from rising or declining currencies can have rippling effects, as that volatility can flow over to bonds and equities, and that very much can impact what are invested in our portfolios. But it also impacts those investments that are international. By using your dollars to purchase international investments, it's kind of a double-edged sword. You're going to get hit from both ends, to where those are negatively, the rising dollar can show that there's actually weakness internationally. And so those international investments can be impacted negatively. And then you're also then losing on the cross currency as well. And so we always want to take that in consideration whenever we do take on international exposure. Something we have, like I mentioned, we have talked about several times on the market Carver, that we're always interested in looking internationally. We want to look for that type of diversification when it's attractive, but it's not a requirement. We're not going to load the boat internationally just because we have to, or just because to give more things to give us diversification. We want to look for attractive opportunities, and currencies play a big impact in that.
Bingo. And so kind of pivoting here, and I want to pass the ball right back to you as we talk about Nasdaq stocks. So moving from currencies to stocks and squarely into your wheelhouse, let you talk about what you see going on there.
Yeah, a lot of movement going on in Nasdaq stocks. We have to remember Nasdaq, the stocks that are listed on Nasdaq, a lot of technology, can be a little bit more volatile. And so a little bit higher beta if we want to use some fancy investment words. But Nasdaq had a pretty large decline last month. April, the Nasdaq composite dropped. The Nasdaq 100 dropped a little over 13%, 13.4%. This is the largest decline actually since going back to 2008. You can see there on the far right, the down bar. We had to really track that. We have to go all the way back to the financial crisis. Just really shows what is kind of going on below the surface for a lot of these tech stocks. Again, Nasdaq 100, the 100 largest stocks that trade in the Nasdaq composite. A big part of what caused a lot of the volatility last week. This has obviously been going on. It's more than just what happened on Friday, but last week we had a big decline in Amazon. Amazon reported their numbers. Remember that Amazon has two kind of components to their business. They have the software, the cloud computing component, and they also obviously have the retail for the consumer side. And some of the numbers they reported on the consumer side, a little bit disappointing to what Wall Street was looking for. And they had one of the largest, actually the second largest one-day loss in value in history. Obviously, that's the big asterisk there, is as the stock market goes up, companies become more valuable, their market value is going to be obviously inflated compared to history. But it was actually the second largest one-day value decline. They lost a little over $200 billion on Friday. What makes this statistic kind of interesting is they also, still staying within this year, had the second largest value increase. Back in February, they went up $191 billion. A lot of billions going up and down. That was back on February 4th. So just to show kind of the volatility we've seen this year in kind of both directions, where stocks are seeing big jumps higher, but also unfortunately seeing large moves lower. In fact, 3 of the largest one-day declines have all actually happened this year, between Nasdaq, Facebook, and Amazon, all seeing large declines, single-day declines this year. And that's having obviously a negative impact then on the tech sector and Nasdaq, as we can see on this chart here. And so whenever we see this type of volatility, some people say, well, is that an opportunity? And it's something we're always looking for when stocks get thrown out with the proverbial bathwater, but we also obviously don't want to act blindly. So we are always looking for opportunity in different stocks that are getting sold off right now, putting them on our watch list and being patient, prudent investors to see when the right risk reward enters the picture. But definitely seeing a lot of downside volatility with these stocks, as the consumer very much is in the forefront in the spotlight with inflation and all the other things that are going on in the world. And Amazon's big drop had a big impact on the overall market.
All right. Now, our last point, we're going to talk about valuations here. So it seems like Andrew and I, we've had to share with you a lot of, I guess, gloomier outlook, things that haven't really been positive development in the markets. Not all bad here, but on the net. We have definitely been slanted more on the defensive side, more bearish, but we'll give you something positive to look forward. Now, when we talk about valuations, it's always important to remember this means absolutely nothing. And from a mathematical sense, literally means nothing over the short run, say 12 months. And over the long run, for that matter, too, the only thing that really matters is earnings going up. But over the medium term, valuation can really represent what you can have in terms of an outlook. And what we see is a bargain developing in smaller caps. So we may very well be in this period that could be a long kind of slog for these large cap companies, which dominated since the bottom in 2008. But what we see is that they are correcting. That is the red line on this chart. That is their price per dollar earnings that you're willing to pay has been coming back down after spending time in 22, 23, 24. That's a very high level, some would say nosebleed level of dollars per earnings. That has been coming down, and you see that in the S&P 500 price. But what we see is that the smaller caps, they can look at the S&P 600. So those are small cap companies trading at 12.5 times earnings. So historically speaking, that is a pretty low number. That doesn't mean that we'll bounce, that we won't see 10 or something even lower over the near term, but we should expect over time we should gravitate back towards something closer to average, which would be, represent something higher than here for small cap. So even if we see a long slog where large companies continue to see their valuations underwater or continuing to come back down, that we might very well see the opposite. That's also very reminiscent. It doesn't mean that we'll have to rhyme or follow the early 2000s, but something very similar to this happened in the early 2000s, where investors did relatively well in small caps, all while the S&P 500 went absolutely nowhere. So something that we have our mind on and always looking for opportunities, whether they're in large cap or small cap, we get the freedom to be able to fish in either of those ponds. So that's going to be it for this week. Appreciate you taking your time. And Andrew, as always, appreciate your thoughtfulness and all you bring to the table analytically. Don't forget, you got a chance to schedule your meeting with us. You can scan this QR code or call us 800-928-4001. And as always, not to forget, we do a weekly radio show that you can capture over the airwaves through WIBC on Saturday mornings, or more conveniently with however you get your podcast. Just search for the Consider This program on your favorite platform. So thanks again and have a great weekend.